Direct labor, variable overhead, supervisor salary, depreciation is not included, general factory overhead is also not included. Right? The concept is the same. Make a differential cost analysis, that's it. Cost and benefit analysis, that's it. So depreciation is a sunk cost. Always, it's not relevant in decision making, so we avoid it. General factory overhead, it says that if we drop it, it will be reallocated to other parts. It is unavoidable, right? It's also not relevant. So should we buy it or keep it or make it? We should make it because it's making it more cheaper than buy from the outside. So what is opportunity cost here? So what is the definition of opportunity cost? It is the benefit foregone opportunity or benefit that is foregone as a result of pursuing some course of action. So opportunities costs are not actual cash outlays and are not recorded in formal accounting of the organization. So we make entries for opportunity cost and all those stuff. So we basically the use of opportunity cost is to make decisions. So how would this concept potentially relate to our previous example, Essex Corporation, Essex company? So you can say that if we outsource it, so we would be losing. Okay. In this case, how we can use the opportunity cost concept in this case? If we make it, we would be saving from or we would be avoiding this loss. How much is the loss? It's 160,000. And if we buy it, we would be increasing, or we would be what is the difference is we would be increasing our cost 160,000, right? So this is just opportunity cost. So, or the other definition is the best next alternative that you foregone is the opportunity cost, or foregone lost income, or in case of expensive, potential saving from our next alternative in case of expenses. So the fourth uses of relevant cost is acceptance of special order. So what is special order? Special order is basically one-time order that will not affect your company's normal business operation. It's a special order whether a special order, whether, for example, you are making here the example of like jewelry. So your normal business operation are like you sell jewelries for 200,000 a month dollar, but special order came with the nature is it's a one-time order, and they gave you some kind of direction. Okay, so what cost? At what cost should you sell it? Right? Since it is one-time game, so fixed cost is not going to be applicable on special order. So look at the impact of fixed cost. If you avoid the fixed cost, then it means only variable cost is going to be relevant here. Because it's one-time order, it's not going to hurt your existing business. The existing customers will not be disappointed and not known. So because this is just for one time. So only incremental costs and benefits here are relevant. We'll do some examples, then you will further understand how we analyze the treatment for special order. So since the existing fixed cost or fixed manufacturing overhead costs would not be affected by the relevant order, special order, so they are not relevant here. So let's just talk about this. So we have Jet Incorporation, which makes a single product whose normal selling price is 20 per unit. So in order to have a special order, you must have extra capacity as well. If you don't have extra capacity, then that is not a special order, right? In order to be categorized as a special order, it must be one time, not disturbing the existing business operation, or which means not hurting the existing customers. Third, you must have the capacity to make it. So the Jet Incorporation has $20 per unit the sale price of the product. A foreign distributor, he asked 3,000 units and he says, I will be giving you $10 per unit. Wow, your price is 20 and he is giving us the quotation for $10. So straightly you will reject it. Look, our selling price is 20 and you are asking us 50% discount. We cannot do that. But as managerial accounting, if you think in terms of relevant and irrelevant costs and decision-making costs, you do some analysis. So it's a one-time order. Okay, this is special order. This is not affecting the business operation. Okay. The actual capacity is 10,000, but you are producing 5,000 units. You still have capacity to make 3,000 units as well. Okay, should we accept the order? Let's just talk about this. So that is a normal routine, your normal income statement. So you are selling 5,000 units at 20 price. So your net operating income is 12,000, right? So your variable costs are like this. So if it's a special order, do we have to incur marketing cost? No. You need to advertise to get the special order? I think no. Fixed cost is no. Marketing cost is no. Right? So all the fixed costs you don't, it's not applicable here. So let's just talk about this. So only variable costs are going to be included here. So variable costs, the total variable cost is going to be this 40 divided by 5,000. So, okay, sorry, my mistake. So I consider this marketing cost as a fixed cost. So this is variable marketing cost, which depends on order and order. Maybe the company did a variable marketing cost to get this special order. Okay. So normally marketing cost, you don't need marketing cost because this is one time. So you don't need to advertise to get it. So since the nature is variable, so you just find out what is your variable cost. So your variable cost is, total cost is 40,000 divided by the units. So your total variable cost is 8 per unit. Special order is not hurting your fixed expense, right? So it costs you for this special order, if you make 3,000 unit. So what is your additional cost? 3,000 multiplied by 8. 3,000 multiplied by 8, 21,000. And the revenue is going to be 3,000 multiplied by 10, 30,000. So 6,000 is going to be the profit you can get. See, if Jet accepts this special order, the incremental revenue will exceed the incremental costs. So we already learned this concept in economics class, marginal revenue and marginal cost concept. So this is the same concept, but in managerial accounting, we are learning in terms of special order concept. So what is the marginal cost? What is the marginal revenue? Or incremental revenue is going to be 30,000. Incremental cost going to be 26,000, 24,000. Income would be 6,000. So should you accept it? Yes, you should accept it because you still have capacity. Your workers are still working with a normal pace, but they are making $5,000. So if you give them a little bit more per unit salaries, you still have capacity. The plant can make still 5,000 units more. You don't need to purchase an additional plant for that one. So you can just pay the variable cost and can earn $6,000 from this special order. Right, David? Sipade?
Makes sense.
Good. So we have this example here. So I'm going to read that one. It's a fairly basics one. So same like previous one. So it's only one small, addition here that I think I need to discuss here. So Northern Optical ordinarily sells the X lens for $50. The variable production cost is 10, fixed cost per unit 18. The variable selling cost is $1. A customer has requested a special order, 10,000 units of the X lenses to be imprinted with the customer logo. The special order would not involve any selling cost, but they have to purchase a machine cost 50,000 which imprints their logo. So what is the rock bottom minimum price below which the company, Northern Optical, should not go into its negotiation with the customer? So what is the minimum amount, that you must receive so that you can sell it? Which means, what is the minimum amount? What is their variable cost? Because fixed cost is not going to be included here in special cost. So let's see the data here. So data here is that we have variable production cost 10. Okay, 10. So variable selling cost, should we include it? The special order would not involve any selling costs, right? No, we should not. So fixed cost is 18. We are not including the fixed cost here. But the customer has requested customization. So only for this special order, we have to purchase 50,000 worth of machinery. Although the nature is fixed cost, but this is customized only related to this special order. So how much? 10,000 units going to be made. So per unit cost is going to be 5. So total is 15. So if the customer is giving us or quoting us the rate above $15, we will accept it. If before $15, we would not affect it. We would not accept that. Understand, David, Christine, Sipade? Sipade, Christine,
Yes, sir.
Chandra,
Yes.
right?
Yes.
So this is how you are going to analyze the relevant costing. So if you understand the concept, please do this example, and this will be the last example. And I'm setting up the breakout room. You have 5 minutes to do that. So just read this part, and then see these variable stuff and per unit cost. Then you will do it very quickly. So I request you to please first read this paragraph, and then revert to the table here. Then you will do it quickly. So I'm going to pause the video here. Meanwhile, please take a picture and try to solve it.
Sure.